What's going on, guys? Welcome back to another video here. We have a big one this evening. We just received some significant data today in terms of those employment revision numbers that we've been talking about. And we also have to recap what was said in the FOMC meeting minutes, which again is leading us to believe that Jerome Powell is going to be on the more dovish side this Friday at the Jackson Hole Symposium speech. But let's get right into it here, team. Again, you guys all know this by now, those of you guys that are watching these videos, that these daily market recap videos are back. So if you guys wouldn't mind going down and hitting that like button on this video here, it costs you nothing to do it, helps me out a whole lot, spreading this information out to as many people who actually want to learn and have long-term success in the market. Because as I always say, guys, information is the edge. You guys are never going to have long-term success putting some cookie cutter nonsense onto your charts and hoping that it is going to work over time, because if it did, there would already be billions of dollars running through things like that. So understanding what's actually happening in the market is critical to your success. So let's first talk a little bit about these BLS numbers here. So the Bureau of Labor Statistics preliminary annual benchmark review of employment data suggests that there were 818,000 fewer jobs in March in this year than were initially reported. Here's why this is important. When you see these big data releases coming out, I mean, again, it's about an average in the 60,000 per month that it was overstated by. When you see this data out in the market, you are going to see people starting to take bond positions. You're also going to see the equity markets move, because the labor market is a very important factor into what everybody's rate expectations are going to be for the near future. So if that data is wrong, well, you're going to see a lot of the market making these knee-jerk reactions after the actual true data is out, and it actually gives you a false sense of what's actually happening in the market. It makes it a little bit more difficult to make some of those short-term decisions. Now, we're also seeing this reflected in what rates are doing today. Now, we've talked about this a lot in the past with these rate cut expectations, but you can see here in the US 10-year yields, I mean, these yields are starting to fall back down to those areas that we were seeing at that time period where the carry trade was 75% unwound, according to JP Morgan, which is absolute nonsense. We're also seeing the dollar significantly moving to the downside here, as we are starting to see rate expectations moving back up, and you're also seeing USD JPY moving to the downside here, which is exactly what we have been saying. Now, I want to touch on something really quickly here. Is that when you see the dollar moving down like this, you could end up saying that this, or seeing this as a flight out of the dollar, less demand for dollars here. And the next kind of logical step along with that thesis would be to say, well, the carry trade is continuously being unwound. But you have to think a little bit more broader than this. Now, if you were to actually unwind the carry trade, what do you have to do? Or parts of this carry trade that these large institutions have? Well, you would need to be selling bonds and selling equities. So we would actually expect to see, with these types of moves down in the dollar, if the carry trade was continuously being unwound, we would then start to expect to see equities coming down and bond yields moving to the upside, which is not what we're seeing right now. So we really do have to wait for those rate cuts, which right now, as we're going to take a look at, are looking like there's going to be a lot more of them, or the kind of severity of them, the amount of these rate cuts is going to be a little bit more than what people were previously expecting. Now, we also received the FOMC meeting minutes today. Now, typically, I don't really put that much emphasis on these meeting minutes, because we already have a good understanding of what was talked about at the last FOMC meeting, due to Jerome Powell coming out, presenting his prepared statements, and the Q&A session that we have. But I did find some interesting things in this FOMC meeting minutes report here that I think we all should pay attention to. So this is kind of the overarching idea of what was happening during the FOMC meeting here. Fed minutes, majority backed easing policy at the next meeting, which is September, if the data aligns. Now think about it like this. What is the data that the Fed is looking at? Well, you got to think about their dual mandate: maximum employment, price stability. So if we continue to see these inflation numbers looking quote unquote good, moving down to that 2% area, and we start to see, or continue to see, elevated unemployment, which that BLS report from today is going to help out with as well, the Fed is going to have everything they need in order to start cutting rates. But by how much is the question? When we take a look here, but risk to employment rise, some support 25 basis point rate cut, concerns over timing of policy changes highlighted, which is what we're going to take a look at. Economic growth outlook downgraded due to weak labor market. So remember, we did have that GDP expectation in the summary of economic projections from the Fed when it came out in June at about 2.1%. So if that's downgraded, then we would expect to see a little bit lower. But I want to bring you guys over here. This is directly from the minutes. In their consideration of monetary policy at this meeting, participants observed that recent indicators suggested that economic activity had continued to expand at a solid pace, job gains have moderated, and the unemployment rate had moved up but remained low. While inflation remained somewhat above the committee's longer run goal of 2%, participants noted that inflation had eased over the past year and that recent incoming data indicated further progress toward the committee's objective. Remember, Powell has said this many times that they need to gain more confidence in the inflation numbers moving towards their 2% target. Is it going to happen? I would say probably not. I've talked about this a lot before on the streams we do every day, that 3% long run target could be that new 2%. But they're still going to stick with that narrative for now. Now, here's where it gets interesting. All participants supported maintaining the target range for the federal funds rate at 5.25% to 5.5%, which we already know, although several observed that the recent progress on inflation and increases in the unemployment rate had provided a probable cause for reducing the target range 25 basis point at this meeting, referring to July, or that they could have supported such a decision. Participants furthermore judged that it was appropriate to continue the process of reducing the Federal Reserve security holdings, basically talking about the runoff of the balance sheet, the Fed selling the assets that it currently holds. Now, this is important here because if they were considering or even talking about a July rate cut, you then have to think to yourself, well, now that we're seeing the data continuously go in this direction of inflation down, employment up, and you're actually seeing the Fed there actually lowering that economic growth outlook due to the weak labor market, what would you then expect to see, or what would you then expect market participants to start pricing in for rate cuts in September? Well, if they were willing or even considering, the thought was in their mind of a 25 basis point cut in July, well, now it's possible that we get the 50 basis point cut in September. And when we come over here and take a look at the Fed Watch tool right now, previously we saw that the expectation for about 125 basis points or 1.25% of cuts by the end of the year was at about 19% yesterday. Now it's risen all the way up to about 30%, with this area right here is kind of in line with what everybody's expecting, that it's either going to be 0.75 or 1 full percentage point of cuts by the end of the year. That actually moved down a little bit. So it took some from this area and moved it back down in here. And you actually saw the expectations for 75 basis points of cutting moved down. So you had the expectation for 75 down. You had 50, or sorry about that, 1 whole percentage point moving down, but you had 1.25% moving up. That's also reflected in the bond market there and the dollar. Bonds yields coming down, the dollar moving down. This is all exactly what we are to expect. Now, after this data here, when we go into Powell on Friday with Jackson Hole, it does make sense for him to be a little bit more dovish. Now, here's the issue. We talked about this in prior videos. If you guys have not seen that big margin call video that I made, make sure you guys go take a look at that. We're not going to go through the whole thesis here, but if the Fed does come out and significantly cut rates here and the dollar continues to weaken, we could easily see USD JPY here start moving down through this lower level that we saw, 140, 170-ish, and you'd see a further unwind of the carry trade, which would cause foreign investors or even some of the domestic investors here, these hedge funds that have put on this carry trade, to sell their assets and pay off the debts that they then have in Japan. So this is incredibly important. Yes, we could end up seeing mortgage rates coming down, but there's a lot more to this than meets the eye, guys. You can't just think to yourself, oh, rates down, market up, economy better. That's not the whole story here. Now, the other thing that I want to keep in mind is that if the bond market and the dollar are already moving so aggressively, which they have been, obviously, these significant moves to the downside, the dollar has been essentially moving off a cliff over the past couple of weeks here. If this continues and these two different things are going to hold here, yields and the dollar, you can then make the argument that they're pricing in these cuts, because that's effectively what's happening. You're seeing the market expectations saying, oh, we expect there to be X amount of cuts by the end of the year. And then they're going to put their money where their mouth is, in the bond market, in the currency market, and also in the equity market. So that is a possibility. Then on the flip side too, remember, is that if Powell doesn't come out and reaffirm kind of this dovish thesis, well, you would probably see a lot of these investors sell off anyway, just because of the recession fears that they already have, which again is why their rate cut expectations are so high to begin with. So that's effectively what we have after today's data, guys. We are going to be receiving the jobs report tomorrow morning, along with a couple of other pieces of data that we're going to be having to look out for at around 8:30 a.m. Eastern. But I really want to talk about this one ticker with you guys that I am very excited to trade. Now, those of you guys that have been following along with that less trades, more profits methodology, I mean, it's pretty obvious to see at this point that, again, that is the way to be operating in the market. You don't want to be trying to scalp all these 1-minute candles, being honestly a little junky in the market here. But again, really focusing on these high quality setups is what's enabled all of us to have so much success throughout this year. And that ticker that I'm looking at here is SMCI. Now, what have we seen on this ticker here? We've seen a significant move to the downside, nice little downtrend. It has recently shifted that downtrend, moved up, and is now consolidating right on its 10 exponential moving average. If we can see a solid push through this 631 area or even the 639 area here, we could easily make a significant move back up to a couple of these levels here at around 730 and 720, which would be absolutely awesome. Now, looking at this as well, remember, we like to take a look at sectors, the overall macro picture as well, which obviously was the first part of this video. But just looking at the semiconductor sector as a whole right now, we can see that it's in a relatively good spot. Again, same thing, significant downtrend, shifting back up, but is actually a little bit more bullish, has made a more significant move to the upside than SMCI has. So SMCI is lagging a little bit. If we do end up seeing SMH here kind of moving back down, converging into its 10 EMA, it is possible that SMCI over here is going to lose its 10 EMA here and start to make a little bit of a move to the downside. In that event, I will still look for it to reclaim that 10, consolidate again, and then potentially break those levels to the upside. But it's been interesting. I mean, we've had some absolutely insane trades recently. I mean, 400 and 500% on the post-earnings strategy. But looking at a ticker like this, I mean, when I start to get a little googly-eyed, ladies and gentlemen, that's really the time that you want to start paying attention. So very interested in this one. I did put a little bit more of a write-up too on my Twitter account. Now, that's a new Twitter account. If you guys think that you're following me on Twitter right now, you're probably not. I did deactivate the old big Twitter account. We're starting a new one here. So if you guys do want to follow that one, it is Short the VIX 2. But that's really going to wrap it up for this one, guys. If you did enjoy, remember, make sure you guys drop a like down below. It helps out a whole lot spreading these streams out to some more people. And yeah, that's it, guys. I'll see you guys in the next one. Peace.